Okay, good afternoon. As I promised you, principles of accounting students, that I will have a videotape for you for problem 4. Okay, it's a comprehensive stockholders' equity, transactions, and stockholders' equity. So this comprehensive problem will cover most of the chapter, most of the ideas on the chapter. So please get your book and go to page 536 of the textbook. The problem says Kraft Unlimited Incorporated was organized and authorized to issue 5,000 shares of $100 par value, 9% preferred stock, and 50,000 shares of no par, $5 stated value, common stock on July 1st, 2014. Stock-related transactions for Kraft Unlimited follow. Now, in this introduction to the problem, there are several points that I want you to pay attention to. And to, let me see, it looks like the lights is not getting too good here. If I see, I think that's also is not even better. I'll just leave it as it is, yeah. Okay, so there are several ideas. Now here the corporation issued 5,000 shares of preferred stock. Okay, the par value of those preferred stock is $100 and 9% preferred. What does the 9% mean? In this case, 9% means that the percentage that's related to the dividends that the preferred shareholders are going to get. In this case, the dividends is going to be number of preferred shares outstanding, number of preferred shares outstanding times par value of the shares times the percentage given, and that's going to give us the dividends that belong to the preferred shareholders. One more time, is going to be number of preferred shares outstanding times the par value times the percentage given. And this, we'll come to that in a minute, yeah. But that's the introduction. Another thing in the introduction of the problem is that the common share have no par value. Instead, they have stated value. Okay, that means it doesn't. In accounting, is the same. You still have to do journal entries for the cash that's being collected. You're going to credit common stock, and you're going to credit the additional paid-in capital in excess of par value. Still the same way as if it is the par value. The only difference is in the minimum legal capital. Okay, in the minimum legal capital, when you have a par value, you have to keep the minimum legal capital, which is equal to the number of common shares outstanding times the par value. That gives you the minimum legal capital. That means that the corporation must keep on hand the minimum legal capital. In this case, if you want to, in this case, it's flexible though. Since we don't have a par value, we have a no par shares. That means the corporation is flexible in terms of how much they should keep in their treasury. Like we said before, some states will not allow no par value. Okay, other states will allow. So that's one of your extra credit assignments, guys. If you can list the states that do not allow the issuance of no par value, okay, that's an extra credit if you want to get an extra credit. Okay, all right, let's go back to the problem now. And on July 1st, on July 1st, issued 10,000 shares of common stock at $11 per share. Okay, now we know the par value is $5, so it was issued with $6 on the top of the par value, and that's the amount that we call paid in capital in excess of par value. So we're going to debit first the cash on July 1st. July 1st, we're going to debit cash. Okay, for how much it was issued for? They issued 10,000 shares at $11, and that's going to give us $11,000. So debit cash for 110,000. 110,000. Okay, $110,000, and we're going to credit common stock. Okay, now 10,000 shares times the par value, which is going to be $50,000, and we're going to credit, okay, additional paid in capital in excess of par value. Additional paid in capital in excess of par value. Additional paid in capital in excess of par value for $60,000. Okay? That is July 1st. They issued $10,000 at an $11 per share, while the par value is $5. Okay, so there was an additional $60,000 raised or on the top of the par value. Now remember that additional is additional capital. It's not a profit. Just be careful. This is a additional capital. The profit only or revenue comes from doing normal operations. All right, so that is July 1st. What comes next? On July 1st, also issued 500 shares of common stock at $11 par value. They issued. Oh, that thing is. Okay, sorry for the noise. Okay, they issued 500 shares of the preferred, 500 shares of common stock at $11 per share. Okay, why did they do that? Okay, per share for services rendered in connection with the organization of the company, and that is called organization cost. Okay, so we're going to debit on first again, debit organization cost, and we're going to credit common stock. Okay, instead of giving the lawyer or whoever is in charge of this organization cost, instead of giving them cash, they are giving them shares of stock, okay, at $11 per share. 500 times 11 is going to give us 5,500. Okay, 5,500. Now, 500 shares times $5 the par value is going to be 2,500. Common stock, 2,500. 2,000. And the difference is, again, additional paid in capital in excess of par value. Credit, additional paid in capital for $43,000. Okay, $43,000. Okay, it looks like the additional capital now has in it $60,000 plus $3,000, $63,000. How many shares we have outstanding? We started with 10,000 shares, and there is additional 500 shares, 10,500. The total number of common shares outstanding at this time. Next is on July 2nd, issued 1,000 shares of preferred stock at par value for cash. Okay, issued 1,000 shares of preferred stock at par value for cash. So on the 2nd, we're going to debit cash. Oh, sorry. Okay, that's fine. We're going to debit cash. Okay, 500 shares at, what is the par value of the preferred shares in the introduction of the problem is $100. So 1,000 shares at 100. So that we're going to give us $100,000. $100,000, and we're going to credit preferred stock at $100,000. Credit preferred stock at $100,000. Okay, 1,000 shares of preferred stock at $100. The par value of the preferred shares will give us $100,000. Okay. All right. That's on the 2nd. On the 3rd, not on the 10th, not the 3rd. On the 10th of July, the corporation issues 2,500 shares of common stock for land. Okay, for land. On which the asking price was $35,000. So the corporations issued 2,500 shares of common stock for land. So in this case, they are buying the land and not paying cash, but they are giving shares of stock. Okay. The land has a value of $35,000. Market value of the stock was $12. So the market value of the shares is $12. We know the par value of the common shares is $5, but the market value is $12 per share. That means this is an additional of $8. Okay. On the top of the, $7. $7 on the top of the par value. However, the management wishes to record the land at the market value of the stock. So they're not going to consider the $35,000. They are going to consider the value of the shares, market value of the shares of the stock. So that means we're going to multiply the 2,500 shares by the $12, and that is going to give us about 30. Let's see. Let me get the calculator in this case. Okay, I can't find the calculator in this. Here it is. Okay, 2,500 shares at $12. 2,500 shares times $12. That's going to give us $30,000. All right. So the value of the land is $30,000. So the management preferred to use the market value per share instead of what is the value of the building, of the land. Sorry. The land is worth 35, but management decided to use the market value per share, which is $12. So 2,500 times 10 times the $12 to give us $30,000. So we're going to debit land on the 10th. We're going to debit land for $30,000, and we're going to credit common stock. Now, 2,500 times the par value of the shares. 2,500 shares times $5. Oh, wait. 2,500 shares times $5. And that's going to give us $12,500. So the value of the common shares is 12,500. Okay, 12,500 shares. And the difference is, as we know, additional capital in excess of par value. Credit additional capital in excess of par value. The difference between 30,000 and 12,500. And that's going to be 17,500. Okay, 17,500. That's on the 10th. Okay, let me mention one thing over here. If the management didn't decide that they're going to use the market value per share, if the management cannot decide or cannot determine what is the market value of the land, then we would have to use the market value of the share as the value of the land, okay? Or if we know what's the value of the land, but we don't know what the market value of the share, then we're going to use the market value of the land as the market value of the shares, okay? All right. That's August 10. And on August 2nd, let's see what happened on August 2nd. I think we still can see it. August 2nd. It says August 2nd, purchased 1,500 shares of its common stock at $13. The corporation buys back 1,500 shares, okay, of its shares for $13 per share. 1,500 shares. The corporations buy back, okay, on August 2nd, purchased 1,500 shares times, okay, times $13. They're going to give us $19,500. When the corporation buys back its share, what do we say we call it? We call it treasury shares, treasury stocks, okay? Remember, the treasury stock is issued, okay, but it's not outstanding. It's no longer in the hands of the public. All right, so it's in the hands of the corporation, and the corporation can buy it, can sell it again. Okay, so we're going to debit, in this case, treasury stock and, okay, we're going to credit cash for 19,000. Oops. Oh, let me clean that. All right, for $19,500. Cash credit, 19,500. This board is not steady. $19,500. All right. So we debit treasury stocks for $19,500 and we credit cash for $19,500. And remember, the cost of this from now on, any accounting or any buying and selling of these shares that they purchased back 1,500, okay, is at $13 a share. That becomes the cost of these shares. So if the corporation have to sell those shares again, we have to consider. We don't go back to the par value, $5. We go back to the $13 per share. Okay. All right. On August 10th. What happened on August 10th? Let me see. Make sure. Put this back maybe. All right. We can see better. On August 10th, the corporation declared dividends. Okay. August 10th, declared cash dividend for 1 month on the outstanding preferred stock and a 2 cents per share on common stock outstanding, payable on August 22 to stockholders of record on August 12. Now remember, when we talked in the previous recording about there are 3 dates associated with the dividends: the declaration date, date of record, and the payment date. Okay, 3 days: declaration, record, and payment date. In this problem on August 10, the declaration date is the 10th, August 10th. The payment date is August 22nd, and the record date is August 12th. On the record date, we do not have a journal entry, but we have to do a journal entry for the declaration date and for the payment date. Now, how much is the amount of dividends in this case? Now, remember, we mentioned here on the top when we started, number of preferred shares outstanding. All right, number of preferred shares outstanding times the par value times the percentage given. Okay, so how many preferred shares outstanding we have? Okay, we have only 1,000 shares. 1,000 shares have only 1,000 shares times the par value 100 times the percentage given 9%. Okay, 1,000 shares times 100 times 9%. How much is that? Okay, let's find out. 1,000 shares times 100 par value times the percentage given, 9%. So that's 9,000 for a year. Okay, 9,000 for a year equal $9,000 for a year. But we want it for 1 month. So we're going to divide 9,000 by 12. Divided by 12. And that's going to give us $750. Okay, $750. Okay, $750 dividends for the preferred shareholders. $750. Again, the number of preferred shares outstanding times the par value times the percentage given. We wrote that formula over here. Okay? And so 1,000 times 100 times 9% give us 9,000 for a whole year. since we are 1 month only, we divide 9,000 by 12, we get $750. All right. Now, the dividends that belong to the common shareholders, okay, they are giving a 2 cents per share on the outstanding shares. So how many shares we have outstanding here? Okay, they started with 10,000. They started with 10,000. Then they issued for the lawyer. How many they issued for the lawyer? 500 shares. 10,000 plus 500 shares. Then they issued $2,500 for the land. For the land plus $2,500. Sorry, 2,500 shares. That give us a total of 13,000. 10,000 plus 500 plus 2,500, that's 13,000. And then the corporation reacquired back. They bought back how many shares? Purchased 1,500. So 13,000 minus 1,500, they're going to give us 11,500. So there are 11,500 common shares outstanding. Let me write those down and then I will erase them. They started with 10,000 shares plus 500 shares for the lawyer, organization cost, plus 2,500 shares for the land, minus 1,500 for treasury shares, the shares that they purchased back. Okay, and so that's going to give us a total of 11,500 shares. So there are 11,500 shares, common shares outstanding, and each share is 2 cents. It's going to get 2 cents. So 11,500 times 2 cents, 11,500 times 0.02, that give us $230. Okay, so the common shares are getting a dividends of $230, and the preferred shares are getting $750. So the total dividends is $230 plus $750 will give us $980 in dividends. The corporation is going to give $980. So $230 for common shares and $750 for preferred. Okay, and that is going to give us total $980. Oh, that doesn't look so good the way it's written. Let me make sure. $980. Okay, $980. 900. 230 for the common shares and $750 for the preferred share, and they add up to $980. So now remember we said there are 3 dates. Date of declaration, we make a journal entry. So on the declaration date, which is the 10th, August 10th, we're going to debit cash dividends declared. Cash dividends declared, and we're going to credit cash dividends payable. Cash dividends payable for how much? $980. $980. Okay? Debit, cash dividends declared. We debit cash dividends declared, and we credit cash dividends payable. Why are we saying cash dividend? Because it could be a stock dividend. Okay, so the dividends can be in stocks and in cash. And instead of getting a cash, you'll be getting a number of shares, depending on the company policy. If they say you may get 2% dividends, 2% stock dividends. If we say 2% stock dividends, that means we're going to multiply the number of common shares outstanding times the 2% times the market value per share. That would give us the dividends in cash. But if we want to find the dividends in number of shares, we just say number of preferred shares, number of common shares outstanding times 2%. And it will give us how many shares will be given in dividend as a dividends. Okay, so that is the declaration date. On the date of record, there is no journal entry. The date of record is on August 12. The date of record is on August 12. And the payment date is on August 22nd. On August 22nd, let me put that, okay, let me clean this portion here. Let me clean this portion here. And so on the payment date, we're going to debit cash dividends declared. Cash dividends declared. And we're going to credit cash because it is payment. Oh, I'll take it back, guys. I'm sorry for that. No, cash dividends payable. Sorry. We're going to debit cash dividends payable. All right? We do a reversing of the declaration date. Debit cash dividends payable and credit cash for $980. $980. Okay? I do believe now we are through with this problem, and we are through with chapter 13. We covered most of the majority of the topics, and I think we have one issue that needs some attention, which is the book value per share. If we were to find the book value per share for the, let me clean this now for just a second and talk briefly about that. Okay. The book value per share, let's say for a preferred stock. That means you're going to figure out the total equity that belongs to the preferred shareholders. Let me put it in this way. Okay. Book value per preferred share per preferred share is equal to total equity that belongs to preferred shareholders, total equity for total equity for preferred shareholders divided by number of preferred shares outstanding. Okay, the denominator is number of preferred shares outstanding. For the numerator, what does the equity of the preferred shares include? What does the equity, the numerator, what does it include? It includes the par value, number of shares outstanding times par value plus any dividend plus additional capital, if any. Additional PIC, additional paid in capital in excess of par, if any. Okay, I put here if any, plus dividends in arrear, if any. Dividends in arrear, if any. That is the numerator. Okay, number of shares, preferred shares outstanding. Okay, number of preferred shares outstanding times par value plus additional paid in capital, if any, plus dividends in arrear, if any. Now, I want to call your attention to one point here. If we know what the market value of the preferred share, okay, let's say in our case, problem 4, the par value is $100. If also we know that the market value is $115, then instead of the par value, we say 115. If we don't know what the par value, what the market value is, we'll just stick with the par value. Okay. How many preferred shares we have in our problem? 1,000. That's all what we have. Do we have a dividends in arrear? No, we don't. Do we have additional capital? No, we don't. But they do have a dividends. We have $750. No, that's not dividends in arrear. So we're not worried about that. So is the whole equity at this point that belongs to the preferred shareholder is the 10,000. How many shares they issued? They issued 1,000 shares times 100. That's it. So their equity is 1,000 times 100 is $100,000 divided by number of preferred shares outstanding is 1,000. Okay, and still, so their book value is $100 per share. That's for the preferred stock. So again, the denominator is the total equity. In this case, the preferred share will have only one equity. They don't have additional capital. It's just the par value. Okay, once we figure that out, what is the book value per share for common shares? Well, you got to take all the total stockholders' equity minus the 100,000. So let me write that down here. Book value per common share is equal to total stockholders' equity minus preferred equity divided by number of common shares outstanding. Okay? Well, in this case, we didn't figure what the total stockholders' equity at this point. The problem didn't ask us to do that, but you would have to include in it the preferred shares, 100,000, plus the common equity, all those, which would be, we started with 50,000 plus 2,500, okay, plus 12,500, okay, minus 19,500, the treasury shares, okay, that would give us the par value of the common shares, plus the PIC. If we go back through the problem from the beginning, we had 3,000 plus 17,500 from the land. That's it. That's the additional capital. So we add the value of the par value of the common share plus their additional capital. Okay, that will give us the common shareholders' equity plus the 100,000. That's the total stockholders' equity. So when we say total stockholders' equity minus preferred equity, the 100,000 divided by number of common shares. How many common shares outstanding we have? We started with how much we started. The problem says, okay, was organized and authorized to issue 5,000, that's preferred shares. 50,000 shares. 50,000 shares, preferred stock, and 50,000 shares of no par. That was the authorization. But the outstanding are the 10,000 for the at the beginning, plus 500 shares. Okay, that was issued on for the lawyer. That's 1,500, plus 2,500 for the land. That's 13,000 total minus 1,500. That's the number of common shares outstanding. Okay, so I think that's we already talked about the stock split, but we have other issues, very minor issues, like, for example, when a cash dividends is declared, what's the effect of it on total stockholders' equity? Now remember, when you give cash dividends, that means cash is getting out of the corporations. That means a reduction in retained earnings. So the total stockholder equity will go down. But if we get stock dividends, we give shares of stocks instead of cash, nothing actually is getting out of the corporations. We take it out of retained earnings and we put it in the contributed capital. Okay, when we give cash dividends, there is no effect on contributed capital. Okay, the effect is going to be on retained earnings and on total stockholders' equity. But when we give stock dividends, shares of stocks, the contributed capital will increase and the retained earnings will decrease. Okay, but the total will not. It stays the same. Total stockholders' equity stays the same. Okay, I think that is the end of this problem and the end of chapter 13, and hopefully By the grace of God, we will start next week on chapter 14, where we cover the bonds, okay, long-term liabilities. Particularly, we focus on the bonds, okay? And everyone, have a blessed day. And let me get out of this.